Mortgage Minutes, Jim Black and Tristan. What's up, buddy? How are you?
Good to see you, my friend. How's the weather in LA
It's
today?
nice. I'm a little cold though because you know how we're going to talk about rate sensitivity. I'm weather sensitive.
You guys, you Southern California people.
I know.
I tell you.
Listen, you guys are used to like it being like 30 and then it's like 70 over there. I'm like, what the hell, man? That's schizo weather.
Yeah, I have to go surf uphill both ways through snow to get to my office. So, I mean,
You're
no,
funny.
I don't make fun of it because I know people throughout the country right now are having weather issues, obviously, but hope they're all
Yeah.
safe and warm.
This is
So,
true. This is
yeah,
true. All right.
cool.
Tell me about this
Yes,
because I want to just give you how I'm thinking about it because you're the pro when it comes to lending, the mortgage world. So help me understand. Rates are like low sixes right now on average, right? We can get them in the fives with you, but on average, low sixes. And then we saw the Greenland situation. We saw tariffs, even though they were removed off the table and say we're going to work together. That shot up rates, mortgage rates specifically. And then it causes something like this. So how do you see this and how do you interpret it?
absolutely. So we saw a increase last quarter in activity because we saw rates drop when Trump announced his $200 billion quantitative easing, right? Buying more bonds.
Hmm.
That $200 billion is a small amount relative to the $1 trillion industry. So it had a quick reaction for lower rates, but then it actually bounced back higher the next day. So what I see as being the magical number to be aware of is 6%. Rates
Okay.
higher than 6% really slows down the appetite for buying a home. When you get below 6%, that emotional element, that psychological 5.99 or better, really spurs up activity. So we're seeing that real 6% number truly be the litmus test for what's happening. Above that, things are slowing down. Get below that, we're seeing a surge of activity. People are
Okay.
excited about it. And ironically, on a $450,000 loan, the difference of an eighth in rate is not something very substantial. We're talking maybe 15, $20 a month. But for whatever reason, that psychological element is a big confidence booster or confidence drainer in people's ability to go borrow and want to go buy something.
Okay. So with that, then explain to me they were saying that originally it was going to be 200 billion,
Billion.
right?
Yep.
And then I heard, and I didn't look into it more, then I heard it was going to be more, 450 billion. Does that
Correct.
does that push mortgage rates slightly under six nationally? Or
It
what do you think?
should. It should again by the pure supply and demand of the buying capacity. Like we talked about last week, if there are more buyers for a bond,
Okay.
the bonds go lower. If you and I are competing for a bond at 6.5%, I may say, I'll buy that bond at coupon rate of 6 3/8. So a lower return. It's the reverse psychology of when you have 10 people trying to buy one vehicle, the price is probably higher or home's higher.
Yeah.
When you have a lot of buyers buying bonds, they're willing to take less of a return to guarantee that security in that return. So
Got it.
bonds should go lower, which means rates should go lower as there's more capital infused into buying these bonds. So
Okay, then the question we've got a few minutes so you can explain this to us, okay? So now let's say it's going to be 400, a little over 400 billion, and mortgage rates are going to come down. But where did they make this money from? How does that affect us longer term? Explain that to me.
sure, we've printed a ton of money. 1/5 of all currency printed in the United States was been printed in the last 5 years.
Well, because of COVID and all that, right?
Exactly, right?
Okay.
So we printed money. Also during war times, we tend to print more money that gets shipped overseas to help infrastructure, pay for things, whatever it might be. So you have to realize we keep kicking the can on inflation down the road.
Okay.
People that make minimum wage, that have a fixed wage, have a hard time adjusting to that because if the wage is fixed and inflation continues to happen, not one category, but all categories of pricing go higher.
Mm.
So it's not just the milk, it's not just the eggs, it's gasoline, it's costs of durable and non-durable goods, which are basically things like food versus materials to build. So you have to think about that inflation hurts all categories pretty much evenly across the board. So
So
again, if
now,
someone's on a fixed income and inflation continues to stay high, their buying power is less, and they're more likely to be in towards a poverty position versus a confident position of being able to spend more money.
got it. Okay, so we're printing more money. Inflation's probably going to go up a little bit, right? And
Yep.
this is why. So for those people that are looking at the Fed saying, why don't they just drop the rate, not the mortgage rate, the rate, right? Like just drop the damn rate already. This is why he can't. This
Exactly. It just creates more
Powell.
inflation.
This
Yeah.
is why he can't do it because we're
Exactly. You
printing
can't
money.
do that. That's not a smart move for the economy. It's great for one segment, housing, but
Yeah,
ironically, it could hurt homeowners more in other categories. If inflation goes to 5%, who cares if you saved a quarter percent in rate,
dude, that'd be crazy
right?
if
So
it's
who
at
cares?
five.
So right now we've been hovering around about 2.7 to 2.9 inflationary number. The main focus right now for the Fed is employment over inflation. They want to keep people employed. So they're worried about employment numbers more than they are inflation. So that's an important thing to think about there. That's a temporary mindset. You want to think about both those equally, but right now we want to create job stability with a lot of changes in AI to political tariffs to political environments to all kinds of things going on. Stable job growth is very important, and that's what they're focused on.
That makes sense. Dude, great place to end it. So it's so crazy. Like I've been in real estate for 22 years and I'm still learning like all
I
the
thought you were brand new.
nuances.
I thought you started yesterday. No?
Did I say 22? I meant 22 minutes.
Okay,
22
cool. That's
minutes.
what I thought.
I misspoke. Thanks,
All
Jim.
right. Good seeing you, my friend. Have a great week. Appreciate you guys. And yeah, know before you owe.
Thanks, everybody.
Take care.